Uh, Good afternoon, everyone. A very warm welcome to all of you to yet another insightful session of the Brain Gain Expertise series organized by the Accounting Standards Board of the ICI. We are thrilled to have you join us today for a session on a critical area accounting for financial instruments and fair value measurements. This 11th webinar in the series continues our endeavor to provide professionals with expert perspective and practical knowledge on key accounting developments. We believe that today's session will equip you with meaningful insights, practical approaches, and real world applications in the accounting of financial instruments and fair value measurements, enabling us to address complexities, enhance transparency, and ensure compliance in financial reporting. We are privileged to extend a very warm welcome to our esteemed speaker for the day, CA Siddharth Iyer. Thank you for joining us, sir. Before we move into the technical session, allow me to briefly introduce our moderator for today's webinar, CA Tarun Mathur. CA Tarun Mathur is a chartered accountant with over 15 years of diverse experience in audit and assurance and is currently working as manager in accounting advisory team with one of the big four auditing firms. He has led accounting advisory engagements for large corporates relating to multiple accounting and financial reporting matters under Ind AS and IFRS. He has been involved in content development and delivery of trainings on various accounting topics such as revenue, leases, consolidation, business combinations at various company specific trainings and internal trainings. I now invite CA Tarun Mathur sir to take the session forward by introducing our distinguished speaker for today's session, CA Siddharth Iyer sir. Over to you, sir.
Thank you, Rahul, for the introduction, and a warm welcome to everyone for this session. And first of all, I would just like to thank the Institute and the Accounting Standards Board for giving me this opportunity to moderate the session on a very crucial topic, which is regarding the accounting for financial instruments and the fair value measurements. This is one of the most basic concept which prevails and it's pervasive throughout the financial statements of any organization, be it a small organization or be it a large organization. Concepts of financial instruments, financial assets, financial liabilities, and how to distinguish between financial liabilities and equity. Then concepts on compound financial instruments and on certain off-balance sheet items like financial guarantees. All of these are covered under the concepts under the standard of financial instruments. And these all financial instruments are something which are common to the smallest of the organizations and even the largest of the organizations. And to take forward this session, today we have our esteemed speaker, Mr. Siddharth Iyer, who has more than 20 years of experience, vast experience across the accounting, reporting, statutory audit, and accounting advisory field in multi-GAAP reporting of Ind AS, IFRS, US GAAP, and has been involved in statutory audits of large listed companies in India, on the NYSE, on the London Stock Exchange. And he has been involved in the complex financial instruments as well as revenue recognition, consolidation, business combination, all of these accounting and reporting concepts. So with that, I would like to hand over to Mr. Siddharth Iyer so that he can commence the session.
Yeah, hi. Good afternoon, everyone. Thank you, Tarun, for providing me the opportunity to speak on this topic on accounting for financial instruments and fair value measurement. So whenever I, do anything on accounting for financial instruments, I think of a time, when I was trying to, solve a very complex accounting query relating to financial instruments, whether it is a debt or a liability or an equity or a compound instrument, as Tarun had said. It was very, very complex. The instrument had many features, etc. And, the team and me spent a lot of time trying to get to an answer to it. We thought, that we needed to take a break. So, I took a stroll over the Juhu Beach, which is one of the beaches in Mumbai, trying to, get my mind cleared so that, I can get to the solution. As I was walking through, I tripped over a shell and, a genie came out of the shell and said, I've been trapped in this shell for thousands and millions of years. You have freed me now, and I will like to grant you a wish. So think properly, and the wish will be granted. So basically, I thought over, I scratched my head, and I said, I want to go to Sri Lanka, but I have got a phobia. I can't travel by flight. Can you build a bridge over the Arabian Sea directly to Colombo so that I can drive through? The genie looked at me with open eyes, with wide eyes, and said, are you crazy? Do you know amount of infrastructure of road, bricks, etc. that will be wasted, in trying to just develop basically a bridge, try and get over your phobia and go take a flight. So I also then thought about it, and the genie said, okay, I'll give you one more chance, one more wish. Uh, tell me the wish and I'll grant it to you. Then I thought about it and I said, I have a financial instrument problem. I'm not trying to get to a correct answer. Can you help in getting to a solution to this question that I have? When he looked at me, he scratched his head and said, do you want to build a 2-lane bridge or a 4-lane bridge over the Arabian Sea? I can grant that wish. So that's how basically the financial instruments is, extremely, extremely complex. You could have a lot of judgment areas with respect to financial instruments, etc. In this next 2 hours, we will try to go into the basics of the financial instruments and, so that you're aware of what a financial instrument is, etc. I am sharing my screen. Let me know if that is visible. Yeah. Yeah. So basically, which are the 4 standards or the big 4 indices, just like you have the big firms, you have the big 4 indices with respect to financial instruments. So Ind AS 32 basically is one of the earlier standards which deals with financial instruments presentation. It deals with, what's the definition of a financial asset, what's the definition of a financial liability, how do you distinguish between liability and a debt, and equity and a compound instrument. So that is what is dealt with Ind AS 32. Basically, the definition of financial instrument, financial assets, financial liabilities, and how do you distinguish between a liability and an equity, and offsetting of financial assets versus liabilities. Then you have basically the main standard, which is Ind AS 109, which deals with classification, measurement, and recognition of financial instruments, both financial assets and liabilities. When do you recognize the financial instrument in the books? How do you classify it? Is it measured at amortized cost? Is it at FVTPL? Is it at FVOCI? So that basically deals with the overall accounting for the financial instruments. The crux of it sits in Ind AS 109. Then you have the disclosure standard, which is Ind AS 107, where you have a lot of disclosures which required to be given with respect to financial instruments. What are the various types of financial instruments that you hold, the significance of the financial instruments, the valuation techniques used, etc., with respect to financial instruments. And then you have basically the overall accounting standard on Ind AS 113, which is fair value measurement, while Ind AS 113 deals with other accounting standards as well. But major part of Ind AS 113 is devoted to also the financial assets and financial liabilities, which are required to be measured at fair value. So how do you measure the fair value, etc.? That is basically driven out of Ind AS 113, where you basically use the guidance given in this standard with respect to how to measure the fair value, and also a host of other disclosures with respect to fair value. So these are the big four standards that we need to be aware of, when we are looking at financial instruments. So what do you mean by financial instruments, and how significant generally basically financial instruments are? So I think financial instruments for banks, NBFCs, etc., they form basically major part of the balance sheet. Around 80 to 90% of the balance sheet would, be consisting of items which are, governed by these standards. While for non-banking or non-financial services sector, a significant part of the financial statements or the balance sheet would consist of financial instruments. So therefore, it's not only important for financial service entities, but it's so equally important for corporate entities which are not in the financial services sector. So we'll go into the details of each of these very shortly. So what do you mean by a financial instrument? Okay, so financial instrument is basically a contract which gives rise to a financial asset to one entity and a financial liability or an equity to another entity. So then the standard goes on to define what is a financial asset and a financial liability. So we will go into the details of what is a financial liability first. So what is important here is to understand that, there should be a contractual obligation. It cannot come from a legal obligation. It has to be a contractual obligation. And for an item to fall under the definition of financial liability, there has to be an obligation to pay cash or any other financial asset. Okay. That is one of the most important definition, that there should be an obligation to pay cash or another financial asset. Then there are other aspects also, to exchange financial assets or liabilities with another entity under conditions that are potentially unfavorable. So this specific line item is more for derivative financial liabilities. And then, there can also be a financial liability when you are basically issuing your own shares. If you're going to be issuing a variable number of shares of your own shares to settle obligation, then that also is considered to be a financial liability. Examples of it would be, compulsorily convertible preference shares, optionally convertible preference shares, optionally convertible debentures. So any such instruments where you are not issuing a fixed number of your own shares, such an instrument would also meet the definition of a financial liability. And again, the fourth one is derivative. So any derivative where you are issuing other than a fixed number of shares for fixed amount of cash, this is generally regarded as a fixed to fixed criteria, would also meet the definition of a financial liability. So what we should be focusing more on is the contractual obligation to pay cash. If there's a contractual obligation to pay cash, then basically it meets the definition of a financial liability. And whether I'm going to be issuing variable number of shares to settle a liability. If I'm going to be issuing variable number of my own shares to settle a liability, then in that case, that instrument will meet a definition of a liability and will not be an equity. Financial asset is the flip side of financial liability. It is basically a contractual obligation or a contractual right, not an obligation, to receive cash or under a financial asset. Second is to exchange financial assets or liabilities with another entity, which is potentially favorable. Basically, this pertains to derivative assets. An equity instrument in another entity. I've invested 10% in Infosys Limited. So that's an equity instrument, and that also falls under the definition of a financial asset. And then if basically there will be something which will be settled with respect to my own equity instruments. I have a receivable which I will settle later, or I will receive money, or I'll receive shares, my own shares for settling this receivable. In that case, and I'm going to receive variable number of shares, it will basically meet the definition of a financial asset. Equity instrument is what is not a financial asset and a liability. It basically represents a residual interest in the assets of the entity. So this is basically the broad three important definitions of financial assets and financial liabilities. So again, quickly to recap, what are the features of a liability? There has to be an obligation to pay cash. A puttable instrument, if the holder of the instrument can, as a put option, to put the instrument back to me, and I'll be required to pay cash and redeem that instrument. In that case, I have an contractual obligation to pay cash, and that instrument will meet the definition of basically a financial liability. Basically, similarly, if there's an indirect obligation to pay cash, indirect could be, where I say I will issue 5 equity shares to settle an obligation, or I'll pay cash of 100 rupees. But the value of the 5 shares is equal to 500 rupees. So I'm not going to be issuing my own equity share of 500 rupees to settle an obligation of 100 rupees. So basically, there's an indirect obligation where I will not settle the liability by issuing fixed number of equity shares. I'll settle the obligation by issuing cash. So that will also meet the definition of a financial liability. We also talked about settlement of any liability by issuing variable number of equity shares. If those features exist, then it will be basically financial liability. There could be contingent settlement provisions, where if an IPO does not happen within 3 years, I'll be required to pay cash. Such instruments would basically be also a financial liability. So it is very, very encompassing. Under Indian GAAP, the definition of what is an equity and what's a liability was pretty simple. If you issue preference shares, it was considered to be an equity, even if it is redeemable. If it is redeemable after 5 years, we should still consider it as an equity. Under Ind AS, there will be a contractual obligation to pay cash. So that instrument will not meet the definition of equity and therefore would be considered to be a liability. So we need to go by the substance of the arrangement and not the form of the arrangement to determine whether an instrument meets the definition of an equity or a liability. Some quick examples. Basically, here in this case, entity A has issued preference shares, which is mandatorily redeemable after 10 years. So whether this instrument will be an equity or a liability. As you see, one of the definitions of important aspect or point for meeting the definition of financial liability is, whether there's a contractual obligation to pay cash. Here, the preference shares is mandatorily redeemable after 10 years, and therefore, there's a contractual obligation to pay cash, and the instrument meets the definition of a financial liability. In Indian GAAP, this instrument would be considered as an equity. So this is a typical example which you would see, where I should say perpetual debentures. And I need to make 8% per annum coupon payment. And I, as an issuer, I have an option whether or not to redeem the debentures after 6 years or 5 years. And the interest of 8% is payable if and only if I declare and pay dividend on my equity shares. If I do not declare and pay dividend on my equity shares, the interest is not payable. And historically, every year I've been declaring dividend on my equity shares. Now, would this instrument be equity or would it be a liability? Now, is there a mandatory redemption option? No, the holder of the instrument is a perpetual debenture. The holder of the instrument cannot demand a redemption. Me as an issuer, after 8 years, in this example, it's 8 years, not 5 years, can redeem the debentures after 8 years, but that is in my option. If I choose not to do it, I need not pay. So I do not have a contractual obligation to repay the principal portion. Now, with respect to interest, is it mandatory to be paid? I need to pay this interest only if I declare and pay dividend on my equity shares. Now, we all know that, paying dividend on equity shares is not mandatory. It is, if the company chooses to declare and the shareholders approve, only in that case, dividend is payable on equity shares. So since the dividend is on equity shares is not mandatory, I can avoid payment of interest on the debentures by not basically declaring dividend. Therefore, there's no contractual obligation to pay cash. In such a case, this instrument is classified as a equity, even though historically I've been paying basically dividend on ordinary shares. That does not matter. I don't have a contractual obligation, and if I in one particular year decide not to pay dividend, in that year I may not pay the interest as well. So since there's no contractual obligation to pay cash, it does not meet the definition of basically a liability, and this instrument is considered to be an equity. So this is basically, again, a company has issued preference shares where there is a 5% dividend that is payable, which is non-cumulative. The shares have to be redeemed basically if there's a change in the applicable tax or accounting requirements. Now, can the company dictate what the accounting and the tax requirements are? No, company cannot. Those are governed by the regulatory authorities and what should be the tax and accounting requirements. So that is not within the hands of the company. So basically, this is considered to be a contingent settlement provision, and I cannot avoid payment, nor can the holder avoid the receipt of the money. So since I cannot avoid the payment of this liability in case the applicable law changes, this entire instrument would be considered, the redemption portion of the dividend will be considered to be a liability. This is one more example. A perpetual debenture is issued and I need to make a payment of 8% per annum annually. So unlike the first example which we did, where the payment of the dividend or the interest on the perpetual debentures was discretionary, here I need to make the 8% per annum annually till the maturity. And since I need to make the 8% per annum annually till maturity, the present value of that assuming that 8% is also the market rate of interest, will come to 100 million, by calculating the fair value of these debentures, and therefore the entire instrument will be considered to be a liability in this case. So slightly tweaking the example, the instrument can be either classified as an equity or as a liability. Therefore, it's very important to understand the contractual terms so that you're able to identify whether an instrument is an equity or a liability. So basically, a company issues an option, and the option is basically can be exercised either at the end of year 1, year 2, or year 3. And basically, the strike price is either 5 rupees, 10 rupees, 5 rupees at the end of year 1, 10 rupees at the end of year 2, and 15 rupees at the end of year 3. So basically, how do you classify this option? Is this option an equity instrument or is it a liability? So again, this is, if it was only one option, the option basically is that the strike price of 5 will be used at all years, either year 1, year 2, or year 3 for issuing one equity share. Then it meets the definition of basically equity. But in this case, 3 possible scenarios are there. I can, at the end of year 1, I can do strike price 5, at the end of year 2, strike price 10, and at the end of year 3, strike price 15. So here, this is one area where there's no clear guidance and there could be different views. One view is, at any point in time, at the end of year 1, only one possible conversion is possible. That is, one equity share, the strike price is 5 rupees. At the end of year 2, one equity share, the strike price is 10 rupees. And at the end of year 3, one equity share, the strike price is 15 rupees. In this scenario, because there's only one possible conversion price at one particular point in time, you can consider that it meets the fixed to fixed criteria that we talked about. I'm issuing only fixed number of shares or fixed amount that I've received, and therefore the instrument is an equity. One view otherwise that could be taken is, over the term of the instrument, there are different possible prices, and therefore, this instrument could meet the definition of a liability. So again, no clear guidance exists, but differing views could take place in these type of scenarios for an instrument to be classified either as an equity or a liability. Therefore, I said, this is one of the more complex areas, and there can be a lot of tweaks to these type of instruments, which where there could be no clear guidance on how to classify such type of instruments, whether it is an equity, a liability, or a compound instrument. So, there could be features, there could be some instrument which has basically features of liability in its entirety. Some instruments could be, where it is equity in its entirety. But there could be, other types of instruments, compound financial instrument, where it could have both, a liability and an equity feature. One of the typical examples of a compound financial instrument is instrument which is, convertible into fixed number of equity shares at the option of the holder of the instruments. And if the holder does not exercise the option to convert into fixed number of equity shares, that bond, if it is a bond which I have issued, that bond will have to be mandatorily redeemed. So here it has features of both a liability, because in case the holder decides not to basically convert the instrument into a fixed number of equity shares, the company, the issuer, will have to basically pay cash. So there's a contractual obligation to pay cash. But in case the holder decides to convert it into equity shares, I'll be issuing fixed number of equity shares, right? So there is an equity feature in it, and there's also a liability feature in it. So this is typically basically a compound instrument. But there could also be a hybrid instrument, which is basically a liability instrument with an embedded derivative in it. Where I could issue a convertible debenture where the conversion feature does not meet the fixed to fixed criteria. The conversion feature could be, variable number of shares, basis the market index. And therefore, I'll not be issuing fixed number of shares. And in case they decide not to convert, then I will be basically paying cash. So in this scenario, it is a hybrid instrument because there's no equity feature, but there's also an derivative within the entire instrument. And then, how do you account for this embedded derivative? Whether you separate out the embedded derivative in this financial liability or measure the entire instruments, which we will briefly touch upon in the subsequent slide. And there could be scenarios when an instrument could be entirely financial liability, basically a debenture which has no conversion features, and which will be redeemed at the end of the maturity. Such instruments are financial liability without any embedded derivative features. So we'll briefly touch upon what do you mean by embedded derivatives. So basically, embedded derivative is, sometimes we issue hybrid instruments, which basically has a typical plain vanilla borrowing agreement. And also there could be some element within the entire instrument which could meet the definition of a embedded derivative. Like I issued debentures, okay, where I pay interest payment basis the index, Sensex index, BSE Sensex index. And therefore, and then at the end of 5 years, I will pay the interest basis the moment in the BSE Sensex index and also the principal amount in cash. Now, this instrument, has a derivative, I'm making the payments basis the moment in the index Sensex. So basically, this is not a plain vanilla borrowing. I'm not paying, 10% or 11% interest. I may either not pay if the Sensex has fallen, if the Sensex was say at 20,000 level on the day I issue the instrument. If it goes below 20,000, I pay no interest. If it goes 22,000, I will pay, 10,000 rupees as interest. If it goes above 25,000, I pay 30,000 rupees as interest. So this is, amount of payment is not based on a plain vanilla debt contract, and it's not closely related to the host contract. So such instruments are generally meeting the definition of a derivative instrument because I am exposed to either a gain and loss basis the underlying, which is not whose risk is not similar to the host contract, which is the borrowing, and that derivative would need to ideally be separated out from the host contract and measured at fair value through P&L. But Ind AS 32 gives a choice, an accounting policy choice, where I decide not to separate the embedded derivative and measure the entire instrument at fair value. In case I decide to separate the embedded derivative, the host borrowing contract will be measured at amortized cost, and the derivatives will be measured at FVTPL. So that is one way of accounting for it. The another way of accounting for it is the entire instrument basically is measured at FVTPL. So then I also had briefly touched upon, another type of instrument, which is considered to be a compound financial instrument. So what do you mean by a compound financial instrument? It is an instrument which is basically having both a liability feature as well as an equity component. So any instrument which has both an equity component and a liability component, you need to do split accounting. And, the proceeds that you receive from issuing such type of instrument. So I have, say, issued optionally convertible preference shares. And in that case, the optionally convertible preference shares, I can holder has a right to convert it into fixed number of equity shares. And if the holder does not convert it into fixed number of equity shares, I will need to make a payment of the liability as well as the interest. So such instrument basically has both a liability component and an equity component. So how do I measure such instruments? Now, how do I split the proceeds that I've received from issuing these preference shares into equity or a liability component? So the guidance says, first I need to determine the carrying amount of the liability component. So how do you determine the carrying amount of the liability component? I will first plot all the cash outflows if the conversion feature was not exercised. So basis that, I will plot all the cash flows, assuming that the holder will not basically convert the preference shares into equity shares and will choose redemption. I'll plot what will be my cash flows. I will discount these cash flows using a market rate of interest for a borrowing of a similar size, which has no conversion feature. So if the issuer were to take a plain vanilla borrowing with similar cash outflows, what would be the interest that he would be paying? So I will discount these cash flows with that interest, the market rate of interest for a borrowing with no conversion feature, determine the present value of that, and that will be the carrying amount of the liability at inception. The total proceeds received minus the carrying amount of the liability will be the equity component. It's the residual amount, the balancing figure. That is how basically the compound financial instrument initial accounting is done. This is an example which basically, entity A has issued 2,000 convertible bonds. The bonds have a 3-year term and have been issued at 1,000 per bond. So the total proceeds that I've received is 2 million. Interest is payable annually at 6%. Each bond is convertible at the holder's discretion into 250 ordinary shares. And when the bonds were issued, the market rate of interest for a similar debt is 9%. So now I will calculate basically the liability component first. How do I determine the liability component? What is the mandatory interest that I pay? I'm paying an interest of 1,20,000 per year, and at the end of each year, so I'll determine the present value of the mandatory. It is paid at the end of 3 years in this example. So 1,20,000 will accrue, and I'll pay the total 1,20,000 cumulatively to 3,60,000 at the end of 3 years. So what is the present value of 3,60,000, which I'm going to pay at the end of 3 years today? So the present value, if I discount it at 9%, comes to 3,03,755. I will also repay the principal of 2 million at the end of 3 years. So if I discount that again at the end of 3 years, that comes to 1,05,444,367. So basically, the total liability component is 1.8 million. The proceeds from the issue is 2 million, and the residual component is a balancing number, which is the equity component. This is the entry that I'll record: cash account debit 2 million, which is what I received when I issued the bonds. Financial liability will be 1,848,122, and equity component will be 151,878. So this is the accounting that I'll do, and then I'll calculate the IRR basis, 1.8 million at 9%. So I'll record interest of 9% per annum on the base amount of 1.8 million using the EIR method. And when that is calculated, that will come to 2 million at the end of 3 years. And then along with the interest, which will get accrued, that will get repaid in case the bond is not converted. So this is the basic accounting for a compound financial instrument, which is issued by a company. So this is regarding the basics of presentation of financial liabilities. So basically, whether it is an equity or a liability, and how do you determine whether an instrument meets the definition of an equity or a financial liability? What's the compound instrument? What is basically a hybrid instrument? How do you account for hybrid instrument? How do you separate out basically the embedded derivative in case you decide to separate out the embedded derivative? So we have touched base upon basically the financial liability part. One part of the financial liability, which is whether you measure the financial liability as amortized cost or at fair value, etc. That will come in later. But major part of what is a financial liability has been discussed. So now we will go to classification of financial assets. So what do you mean by financial assets? If you go through the definition of a financial asset, it basically says a contractual obligation to a contractual right to receive cash, right? Or another financial asset. Basically, equity instrument of another entity. If I've invested in equity shares of another entity, and any instrument that will be settled, or any receivable that will be settled by receiving variable number of my own equity shares, those are basically the definition of a financial asset. So we should keep in mind the definition of a financial asset. What are the examples of financial asset? Trade receivable. Yes, trade receivable is a financial asset because I have a contractual right to receive cash. Security deposit. Yes, it will meet the definition of financial asset because I have a contractual right to receive cash. Investment in equity shares of a company, yes, it will meet the definition because financial asset definition envisages an equity instrument in another entity. Prepaid expenses, no. Prepaid expenses, I don't have a contractual right to receive cash, and it does not meet any of the other criteria, so that is not a financial asset. Income tax receivable, again, income tax receivable is a legal right, not a contractual right. Therefore, that will not meet the definition of a financial asset. It will be considered to be a non-financial asset. That is how you basically determine what a financial asset is. Once you determine that, item in the balance sheet side of the entity is a financial asset, then you go to the next step is to determine its classification, whether it is amortized cost, whether you measure it at amortized cost, whether you measure it at fair value to P&L, or whether it is fair value through OCI. So that is the next step that we do to determine once you determine that an item is a financial asset. So basically, there are three categories in which financial asset is classified. One is amortized cost. The second is basically fair value through other comprehensive income, and the third one is fair value through P&L. I'll go into the details of each of these separately. Again, fair value through OCI is basically split to what can be reclassified and what cannot be reclassified. The debt instruments, the gain and loss on the debt instruments will be reclassified from OCI to P&L when they are sold. So they are a different type of FVOCI instruments. While equity instruments, if you designate some instrument as FVOCI, equity FVOCI, the gain and loss on those instruments do not get flushed to the P&L even when the equity instruments are sold. They remain within equity. So those are the second type or category of FVOCI instruments. So basically, let's first talk about amortized cost. So when does a particular item or in the balance sheet, which is a financial asset, meet the criteria to be measured at amortized cost? So for most companies, especially for non-corporates, 70 to 80% or sometimes close to 100% of the financial assets will meet the amortized cost criteria. Okay, so there are two things that you need to do to ensure that basically the financial asset meets the criteria for amortized cost. One is the contractual cash flow characteristics test. Basically, you need to understand the terms of the instrument to see whether it meets this. Similar to a debt instrument, means am I going to receive cash? Is it meeting the SPPI criteria, simply payment of principal and interest? So am I going to get the payment of principal and interest with respect to that instrument? So if I'm going to get the payment of principal and interest, in that case, it meets the contractual cash flow characteristics. So simple example is, I've invested in government securities. I am going to be getting the repayment of the government security when it matures, and I'll also be getting annual payments of interest. It meets the contractual cash flow characteristics test. Similarly, trade receivable also, while there may not be any interest because they're short-term in nature, it meets the contractual cash flow characteristics test because I'm going to get the repayment of principal at the end, and they're short-term in nature, and therefore it technically there's no requirement for the interest to be received with respect to these instruments. So if there's any instrument which meets the contractual cash flow characteristics test, then first test for the amortized cost classification is met. What could be instruments which do not meet the SPPI or the contractual cash flow test? If I have invested in convertible bonds, where I will get basically either interest and principal, or I can convert into equity shares of the issuer, that does not meet the contractual cash flow characteristics test, because it's not only payment of principal and interest, I'm getting something more. And because I'm getting something more, that does not meet the contractual cash flow characteristics test. So if it doesn't meet this test, then you don't go to the second, which is the business model test. But assuming that it meets the contractual cash flow test, we go to the next, which is the hold to collect. Then what you see is, what is the management or the board's view of holding these financial assets? Is it to collect the contractual cash flows? Means, will I wait till the maturity? If I invested in bonds, will I wait till its maturity? If remaining tenure is 5 years, will I wait till maturity to collect the contractual cash flow? Or will I sell the shares or the bonds before maturity? Not shares, bonds before maturity. So if my business model is to collect the contractual cash flows, in that case, the business model is met. So if both the contractual cash flow and the business model is met, then I basically will classify that instrument as amortized cost. And that is basically the simplest form of accounting, where you measure the financial assets using the effective interest rate method. I'll come to the effective interest rate method. I do not fair value the instruments at the end of each period. basically it is more or less equal to cost, giving the impact of EIR for any transaction cost that I would incur. But that's why I said, most of the instruments will meet the criteria of amortized cost. You have trade receivables, you have fixed deposits, you would have investment in debentures of corporates, etc. So if you are going to hold it till maturity, these will meet the hold to collect and contractual cash flow test, and therefore will be measured at amortized cost. So in most corporates, you would see that the financial assets are classified as amortized cost. And that could be, some deviations, if I have trade receivables and I enter into factoring arrangements, okay, where I sell so the payment terms is, I'll receive the payment from the debtor within 6 months, but I basically, in certain circumstances, will sell some of the financial assets before its maturity to a bank. I factor the receivables. In that case, I'm not holding it to collect. I'm selling the receivables before basically the contractual cash flow is received. And when I'm selling the the receivables to a factoring arrangement and meets the recognition requirement, basically, then it doesn't meet the business model. While it may meet the derecognition requirement for financial asset to be derecognized, it will not meet the business model test of hold to collect, and therefore, I will not be able to basically present those instruments at amortized cost. So these are the two criteria that I need to determine to measure an instrument at amortized cost. So these are the typical examples of financial assets measured at amortized costs. Trade receivable, assuming there is no factoring arrangement, intercompany loans and receivables, investment in government bonds, which I plan to hold till maturity, etc. So most instruments, as I said, will therefore meet the definition of amortized cost in most scenarios. So, as I said, if I hold some investments, if I'm holding government bonds, and the remaining maturity is 10 years, but I have cases or circumstances when I'm selling these bonds on a regular basis, before the maturity, so then that is not basically, my business model is not hold to collect. My business model is hold to collect and hold to sell. In that scenario, I will not classify those instruments at amortized cost. I'll classify those instruments basically at FVOCI. Then similarly, as I said, one more thing that you need to do is the SPPI, the contractual cash flow test. So if I'm basically issuing or invested in convertible notes of an issuer, then I'm going to receive possibly equity shares. So that does not meet the definition of a plain vanilla debt instrument, where I'm getting money for the principal and the interest. So those will not meet the amortized cost criteria. Similarly, the payments are linked EBITDA-based payments, where I'm going to receive interest basis the EBITDA of the borrower. Again, that will not meet the contractual cash flow test, and therefore those instruments cannot be classified as amortized cost. FVOCI for debt instruments, again, there are two aspects. First is the contractual cash flow test. So for FVOCI for debt instruments, the contractual cash flow test remains the same. Basically, there's no difference between amortized cost and FVOCI for debt instruments in respect to contractual cash flow test. Basically, the terms of the instrument must provide for payment of principal and interest. And so I will not go into the contractual cash flow for this category of instrument. But what you basically need to understand is the difference in the business model. With respect to basically FVOCI for debt instruments, my objective is to either hold those instruments till maturity or sell. So I could either hold it till maturity or sell the instrument before maturity, depending upon business needs. I can do both. So in that case, I will not measure it at amortized cost. I will measure those instruments at FVOCI. What do you mean by FVOCI debt instruments? FVOCI debt instruments means first I will measure the instrument at amortized cost. The interest income will be calculated using the EIR method. I will calculate, any expected credit loss on those instruments and will take it to P&L. The interest income also goes to P&L. Any foreign exchange gain loss, if any on the instrument, will also go to P&L. So I will first calculate the amortized cost of the instrument. Once I calculate the amortized cost, take the interest income, etc. to P&L, I will then calculate the fair value of the instrument. And the difference between the fair value and the amortized cost, I will park it to other comprehensive income. And it will continue to remain in other comprehensive income until the time I sell the instrument or it matures. And in that case, the cumulative gain and loss will be basically flushed from OCI to the statement of P&L. So this is basically how I account for a debt instrument, which is classified as debt FVOCI. So a requirement is that you need to fair value the instrument. In amortized cost, you don't fair value. You just calculate the interest income using the EIR method. You calculate the ECL loss, but you don't fair value the instrument. So the difference between amortized cost and debt instrument measured at FVOCI is that you need to do a fair valuation of your debt instrument, which is measured at FVOCI, and take the gain and loss to other comprehensive income. So basically, some examples of basically instruments which will meet the criteria of debt FVOCI are if I've invested in government bonds, which I'm likely to sell depending upon business needs in the future, and I will not hold it till maturity, then those instruments may need to be classified as debt of FVOCI. Then if I have basically trade receivables, and I have a history of entering into significant factoring, not 100% of my receivables, for a significant portion of my receivables, I may enter into factoring arrangements which qualifies for derecognition. In that case, I'm not holding these instruments till maturity, and therefore those instruments basically will not be classified as amortized costs, will be classified as debt instruments. Similarly, if I enter into securitization arrangements which qualifies for derecognition, even those instruments cannot be presented as amortized cost. The significant judgment would be required, in understanding, when our business model for hold to collect and hold to sell is met. Just because there's some sporadic sales, in my investment category or my trade receivables, I've done factoring, say, of 1% or 2% of the total receivables. That doesn't mean that my business model is hold to collect and hold to sell. Some exceptions are allowed, but the standard does not set any benchmarks. So therefore, judgment is required to understand, what level of sales is required for us to classify any instrument as debt FVOCI. The third instrument, is fair value through P&L. So basically, any instruments which I held for trading, are basically the reason for holding those instruments is to gain, make short-term profit or loss. And it's a treasury type of investment which I regularly buy and sell and don't wait till maturity depending upon how the market moves. So such instruments, cannot be even presented as OCI. The gain and loss has to be taken immediately to P&L at the end of each reporting period. Then there could be certain instruments which I can designate at FVP fair value to P&L. That designation is a choice that I make on an instrument by instrument basis, and I do that, generally to avoid an accounting mismatch. I may have a liability which is measured at fair value to P&L, and I will basically to offset the volatility in the P&L because of measuring the financial liability at P&L. I can designate in certain cases with certain criteria are met, certain instruments at FVTPL, so that the gain and loss on the investment will offset the gain and loss on the financial liability. So in case there are such criteria are met, I can designate that instrument as FVP at fair value to P&L. And then residual category is basically if any instrument which does not meet the criteria of amortized cost or debt FVOCI will basically be considered as a residual category which will need to be measured at FVTPL. Example of this is if I have instruments where payments are basis EBITDA of the issuer or convertible notes. I may hold these instruments till maturity, but it doesn't meet the SPPI test. So those will, and those does not meet the definition of an equity also because It's not an equity. I'm going to get payment for that, not invested in equity shares of a company. Those will basically meet the residual category and will need to be measured at fair value through P&L. So third category is, we have debt instruments, and the other category that we have is basically investment in equity shares. So investment in equity shares basically needs to be they're either measured at fair value through P&L, unless basically you do a designation of that instrument, on initial recognition, and you say that the gains and losses of those instruments I will take it to OCI. In case I do that designation, in that case, those instruments the gain and loss on those instruments will be recorded in OCI. I will not take the gains and losses on those instruments to P&L. So if I do that designation, basically, then even when I sell those instruments, after a few years, the cumulative gain and loss recorded in OCI cannot be classified to P&L. They will remain within OCI. They'll remain within equity, and I can reclassify them from OCI line item to any other line item within the reserves, but I cannot take them to P&L. So assume that I invested in equity shares of a company for 100 rupees. And the fair value of that at the end of year one was 150 rupees. So I take the gain of 50 rupees into OCI. Then at the end of year two, I sell the shares for 175 rupees. So I take the additional gain of 175 minus 150 to OCI. So cumulative gain that I made on the shares is 75 rupees. So this 75 rupees, when I sell, I cannot take that 75 rupees gain to P&L. It will continue to be in OCI, and I will reclassify it from OCI line item if required and if permitted by law to any other line item within equity, which is generally retained earnings. So when you sell the shares, I can, in that case, the cumulative gain and loss, I can reclassify from OCI to retained earnings. So this designation or this instrument of investments at FVOCI, I have to do on an investment by investment basis. It's not an accounting policy choice. So one instrument I can designate at FVOCI, the second instrument I might choose not to designate. In that case, the gain and loss on that will be taken to P&L. And once you decide to designate an instrument at FVOCI, that designation cannot change through the life of the instrument. 2 years down the line, I realize that, that I'm going to earn a lot of profit on these instruments, and I want to take the gain to P&L. I cannot say that my designation has changed and now I want to measure those instruments at FVTPL. Standard does not allow you to do that. Once you make the designation on inception, once you purchase those shares, it becomes irrevocable, and the entire gain and loss on that instruments till the time you sell those instruments needs to be recorded in OCI. And cannot be flushed to P&L. The reason why this exception was given was to reduce the volatility in the P&L. Many companies invest in equity shares at small amounts, 2%, 3%, sometimes less than 1%. It may not meet the definition of an associate, joint venture, or subsidiary, and therefore as per the requirements of the standard, those instruments will need to be measured at fair value. Now, if you were to take the fair value gain and loss to P&L, that would have resulted in a lot of volatility in the P&L. To reduce that volatility, they gave an option, with respect to equity instruments, that you can designate those at OCI and record the gain or the loss to OCI and never record it to P&L. To be able to make this designation, that instrument should be an equity instrument from an issuer's perspective. That is also important. If the instrument does not meet the definition of an equity from an issuer's perspective, those instruments cannot be designated at FVOCI. So it is mandatory that you need to measure those investments at fair value. You cannot say that cost is equal to fair value. you could probably do that, initial year, but, in subsequent years, you cannot, get to the justification that cost is equal to fair value. These equity shares will need to be fair valued. And, depending upon whether you designated it at OCI or not, the gain and loss will either need to be recorded in OCI or taken to P&L. So basically, I'll just quickly go to the SPPI test. I said, SPPI test, which is, one of the important factors for determining whether an instrument is, amortized cost, debt FVOCI or FE, fair value to P&L, is that, you should meet the SPPI test. So I'll briefly go into what do you mean by SPPI test. So as I said, SPPI is simply solely payment of principal and interest. So, the instrument should be such that, you should be receiving the payment of principal and interest. Principal is not defined in the accounting standard, but it is generally perceived to be the fair value at which the instrument was initially recorded on day one when you invested in that instrument. And interest is basically nothing but the time value of money and the credit risk that I'm taking. So interest is basically compensation for the time value of money I've invested in an instrument where basically I'll get repaid in 3 years. So of course I will, because I've invested, I will want to earn interest for the time value of money. I've also invested in an instrument and I'm subject to credit risk where the issuer may not repay back. So I will charge a premium for the credit risk as well. So interest can incorporate elements of credit risk of the counterparty of the issuer. Interest will also include, liquidity risk, and profit margin. Basically, if I want to invest, I want to earn some profit also, right? A reasonable profit margin from a lending perspective, and certain administrative costs. So these are the elements that should be there. So it is like a plain vanilla investment in, a debt security. If the instrument has those features, then in that case, it meets the SPPI test. If it has any other features, it may not meet the SPPI test, and such instruments will have to be, most probably measured at fair value through P&L. So these are some of the examples which do not meet the SPPI test, which a bond, I've invested in a bond, and instead of getting fixed rate of interest, I'm getting interest payment which is linked to EBITDA of the issuer. Now, does it meet the definition of a plain vanilla debenture or a plain vanilla debt instrument? I'm not getting compensated only for credit risk and a profit margin. I'm also basically getting compensated for certain other things like the performance of the issuer company. So that is not considered to be a plain vanilla debt instrument. What do you mean by plain vanilla debt instrument? I charge interest, and my interest that I charge generally depends upon my cost of borrowing, the credit risk for the counterparty, and any margins that I want to earn. But here I am basically margin, which is good from an investor perspective, which is suitable for me. But here, I'm earning margins, more depending upon the performance of the issuer. This doesn't meet the SPPI test. So these instruments will have to be measured at fair value through P&L. Similarly, a bond which is issued where the interest payment is linked to commodity prices like the price of gold or copper, etc. Those instruments also do not meet the SPPI test and will have to be measured at fair value through P&L. Similarly, if I have, sold my business subsidiary and there's an earn-out period, where, depending upon the performance of the subsidiary which I sold, I'll get 5% of the profit earned by the subsidiary which the new company has acquired. The new company will pay me 5% of the profit of that subsidiary for 3 years. Now, again, this does not meet the SPPI test and therefore will be considered to be measured at fair value through P&L. There can be, instruments, which has prepayment options, which is very similar. When I borrow basically from a bank, I would like to have a prepayment option, where I can choose to prepay. So that does not taint the SPPI test. Just because there are prepayment options doesn't mean that the SPPI test is not met, is not satisfied. Prepayment options are fine as long as the compensation for prepayment is reasonable, and it compensates the holder or the bank to whom I am prepaying the loan a compensation for early repayment. Suppose yes, invested in my debentures where the interest rate is 10%, and I'm of a AAA rated issuer, and after 2 years I want to prepay the loan. My rating remains AAA. Okay, but the interest rates have fallen over a period of 2 years to 8%. Now, because I'm prepaying the loan, if the bank were to reinvest these in new debentures of a similar company, AAA, you would earn only interest of 8%. So in that scenario, he loses 2%. So, banks may sometimes put in the loan agreement that, reasonable compensation should be paid in case you prepay. So as long as that reasonable compensation is nothing, but to compensate him for the loss of interest because of the prepayment. In that case, the prepayment is considered to be closely related to the host contract, or in our words, meeting the SPPI criteria. Because from asset perspective, I don't separate out the embedded derivative. So in that case, I will say that the SPPI test is met, and therefore, I then go to the business model test and then determine what could be the classification. Then, that could be scenarios where there's an extension option. What do you mean by an extension option? An extension option is basically a scenario where I've taken an initial borrowing for 5 years. The issuer has taken an initial borrowing of 5 years. And at the end of 5 years, basically, the issuer has an option to extend the borrowing for an additional 2 years. Now, as long as the interest rate charged for the extension is equivalent to the market rate at the end of 5 years, in that case, you can say, that such an instrument meets the SPPI criteria, and therefore, from a holder's perspective, the bank which is given this borrowing, the SPPI test is met, and they can potentially measure those instruments at debt FVOCI if the other business model test is met. So again, this is an example. Entity A lends to entity B 5 million at a fixed market rate of interest. The loan is repayable after 5 years, and entity A has an option to repay the loan at any time at accrued interest plus prepayment fee of 2.5%. Now, the prepayment fee of 2.5% represents compensation for loss of interest to the lender. And therefore, since it represents loss of interest to the lender, the SPPI test is met in this scenario. And therefore, I can classify those instruments at amortized cost, assuming that the business model test is met. Similarly, I have company C lends to company D 10 million at a fixed rate of interest. The loan is repayable after 5 years. At the end of 5 years, company D has a right to extend the loan for another 3 years. If company D exercises the option to extend, a variable market rate of interest will be charged during years 6 to 8. So again, at the end of 5 years, a market rate of interest is charged. So if company D were to take a new loan, the same rate of interest would be charged. They'll have to pay market rate of interest. So doesn't really matter whether he goes to this bank or he takes a new loan from somebody else, because the rate of interest that I'm going to be charged is going to be a market rate of interest for this loan as well as any new loan that I take. So therefore, this will meet the SPPI test, and I can potentially measure these instruments at amortized cost. An entity holds a bond that is convertible into equity shares for issuer. This will not meet the SPPI criteria test because I'm getting something other than a debt instrument. I'm exposed to the share price of the issuer company. So this will not meet the SPPI test. It is not only solely for payment of principal and interest, and therefore these instruments will have to be measured at FVTPL if it doesn't meet the definition of an equity from an issuer's perspective. Next, we'll go to basically the initial recognition of financial instruments. So how do you record the financial instruments on initial measurement or initial recognition? So the standard says, all financial assets and financial liabilities needs to be measured on initial measurement at fair value. So it's not necessarily that transaction price is equal to fair value. The standard requires you to measure all the financial assets and liabilities on initial measurement at fair value. And for assets, or liabilities, financial assets or liabilities, which are measured at amortized cost, you will need to adjust, or debt FVOCI instruments, you will need to adjust the transaction cost. So, basically, if I have basically invested in debentures of 100 rupees and paid transaction cost of 5 rupees to invest in these debentures. So assuming that the 100 rupees is the fair value debentures, I will need to adjust the fair value by the transaction cost if I'm measuring the financial assets at amortized cost. So my initial day one will be investment account in debentures, debit 105 to bank, basically 105. And then this 5 rupees of transaction cost gets amortized over the period of the investment using the EIR method, effective interest rate method. So you basically calculate your interest income after considering the amortized transaction cost that I paid on day one. So my interest revenue to that extent over the period of the debentures will reduce by 5 rupees. Of course, the calculation will not be on a straight line basis, but it will be basis the EIR method. Right? With respect to instruments which are measured at fair value through P&L, the transaction costs with respect to those instruments are required to be taken directly to P&L. I don't include the transaction cost with respect to those instruments on initial measurement against the carrying amount of the assets, because I'm measuring those assets anyway at fair value, right? So the transaction cost cannot be included within the carrying amount of any instrument which is measured at fair value. So transaction cost for financial instruments which are measured at fair value P&L needs to be taken to P&L. I don't capitalize those transaction costs. And how do I determine fair value? I determine fair value basis the definition of fair value given in Ind AS 113. As I said, for amortized cost instruments and debt FVOCI instrument, I will need to include the transaction cost within the amortized cost calculation and calculate the EIR basis that. So what do you mean by amortized cost calculation? Amortized cost calculation basically is nothing but and how do I calculate EIR? Basically, so what do you mean by amortized cost of a financial asset? It's the amount that's basically that I recognize at initial recognition. So my cash outflow will be the amount that I paid, which I invested in the financial asset, plus the transaction cost that I paid to acquire the financial asset or the investment. So 100 plus 5, 105 will be my day one outflow. And then the cash inflows that I'm going to receive from these investments needs to be plotted. So if I'm going to receive interest of 10% every year for 3 years, so 10 rupees at the end of 1 year, 10 rupees at the end of the second year, and 10 rupees at the end of the third year. So 30 rupees I'm going to receive as interest. That will be my cash inflow at the end of each year for 3 years. The principal repayment I will get at the end of the third year. So 100 rupees will be my cash inflow at the end of third year. I will basically, calculate the IRR of this, the cash outflow of 105 and the cash inflow of 10, 10, 110. I calculate the EIR or the IRR of this, and I will basically compute interest income basis this IRR that I calculate. Now this IRR, will it be 10%, will it be 11%, or will it be less than 10%? This IRR will be less than 10% because basically if it was 10%, I'm paying 10% coupon, right? So my cash outflow at the end of year one is 10, 10, and 10 for interest. and then 100, of course, of principal. So if I'm basically discounting 10, 10, and 110, but if it is not coming to 100, but my day one is 105, the EIR will be less than 10%, say it's 9%. So that 9% represents the transaction cost of 5 that I paid at inception, which gets amortized. So my interest income will not be 10 rupees each year. It will be less than 10 rupees, which I'll record. So I'll technically record 25 rupees of interest over a period of 3 years using the EIR method. And therefore, my interest will not be calculated at 10%, but it will be calculated at a percentage which is less than 10. So that is how I do the EIR calculation. And then, of course, I also need to basically calculate expected credit loss on these financial assets, which we will discuss separately. So basically, amount recognized at initial recognition less any cash outflows, plus minus interest income, less my ECL will be nothing but the amortized cost of my financial assets that needs to be recorded at the end of which I need to calculate and measure and record at the end of each accounting period. So these have been discussed. What do I do? I plot the cash inflows and cash outflows, so principal repayment, transaction costs, any debentures which are issued at a premium or a discount, and basically the transaction cost is amortized over a period. So basically, let's take this example. Entity A pays a bond at its fair value. It acquires a bond from the market at 90 rupees. The bond matures in 3 years' time. On maturity, the holder is entitled to 100 rupees in cash. There are no other, it's basically a zero coupon bond. There are no other contractual cash flows. What is the effective interest rate? So how do I calculate the interest income? Do I calculate 100 minus 90, 10 rupees, 3.33 rupees each year on a straight line basis? Is that how I do the calculation, or is there any other method by which I need to do the calculation? So 100 minus 90, 10 rupees divided by 3, 3.33 each year is not really permitted unless amounts are not material. So I need to calculate the IRR. So I'm going to get 100 rupees at the end of 3 years. So what is the market rate of interest if I'm going to get, if I invested in this bond and I'm going to get 100 at the end of 3 years? I need to find that out and discount that. And sorry, 100 rupees I'm going to get at the end of 3 years and I pay 90. So I calculate the IRR. I don't take the market rate of interest. I recompute the EIR. And so what is the present value of what's the interest rate which equates 100 rupees to 90 rupees receivable at the end of 3 years to 90 today? And that EIR is 3.57%, and I'll record interest at the rate of 3.57% each year. So it will not be a straight line in recording of interest. Ind AS does not permit you to do that. So how do you measure, a debt instrument which is measured at FVOCI? So how do you measure this? At balance sheet date, the instrument has to be measured at fair value. The interest income, as I said, needs to be computed. You first compute the amortized cost, and then after that you determine the fair value. So when I determine the amortized cost, the interest income as per EIR goes to P&L. I need to also record ECL. Any credit loss that I'm going to incur, that needs to go to P&L. Any foreign exchange gain loss, I need to take to P&L. And so basically the impairment model is the same for debt instruments measured at amortized cost or debt instruments measured at FVOCI. So same approach. Once I calculate the amortized cost, next step I determine the fair value, and the difference between amortized cost and the fair value is recorded on in other comprehensive income. And since it's debt instruments, it is recyclable. And when I sell these instruments, or basically when it is matured, the cumulative gain and loss, if any, in OCI gets recycled to P&L. Then we briefly touched about how you account for equity instruments. So if you have any equity shares which you designate at FVOCI, the gain and loss on those instruments will be recorded in OCI. and you will not recycle it to P&L even when it is sold. Dividend income, if any, on these instruments, however, needs to be taken to P&L. So from a statement of financial position or the balance sheet perspective, the investments have to be measured at fair value. So this is with respect to classification of financial instruments, financial assets. We'll quickly go to classification of financial liabilities. So there are broadly two categories. One is amortized cost. Amortized cost calculation for a financial asset and a financial liability will remain the same. And FVTPL. So 90 to 95% of the financial liabilities will be basically measured at amortized cost. In fact, close to 100% will be generally measured at amortized cost. In certain circumstances, standard envisages that, the financial liability be measured at fair value to P&L. If you have derivative liabilities, etc., then you need to measure it at P&L. Similarly, in certain cases, you have embedded derivative in your, hybrid financial liability instrument. You can designate the entire instrument at fair value to P&L. And only in these limited circumstances can the financial liability be measured at fair value. And in all other cases, it needs to be measured at amortized cost. So basically, these are the examples. Trade payables are an example of amortized cost, bank borrowings, other loan payable, related party payable, etc. They are all generally amortized cost classified. While what will be at FVTPL is any derivative liability, embedded derivatives, basically convertible notes. Where I've designated, I've not separated out the embedded derivative, but I've designated the entire instrument at FVTPL. And contingent consideration, which we also briefly talked about from an asset perspective. Yeah, so we have basically done what do you mean by a financial asset? What do you mean by a financial liability? We also, spoken about what are the various categories or classification of financial assets and financial liabilities. Also, the initial recognition of financial assets and subsequent recognition of financial assets. One aspect that I spoke about was, when you're doing financial assets which are measured at amortized cost or debt instruments, which are basically FVOCI, you need to record an expected credit loss. So what do you mean by expected credit loss? I will briefly talk about expected credit loss. In very simple word is a refined version of our provision for doubtful debts under Indian GAAP. So if I've invested, trade receivable, I sold goods and I don't expect to receive money, I will need to record a provision for doubtful debts in the previous GAAP. Impairment of financial assets is something similar. Similarly, I'm a bank, I've lent to a particular party and that party is unlikely to repay me back. So that is considered a doubtful debt or a doubtful loan. And you need to make a provision for that. So under Indian GAAP, generally what you do is you record a provision for doubtful debts or provision for loan loss when loss is incurred, subject to, of course, from a banking perspective, minimum amount of ECL or not ECL, minimum amount of RBI prudential provisioning is made. But other than that, assuming that RBI regulations are not applicable, under Indian GAAP, basically you record a loss for doubtful debts only when a loss event has happened. Debtor does not pay or is not repaid for 3 months, 6 months, is not responding. So there's always a delay in recording the loss. So it's technically called as an incurred loss model. But under Ind AS 109, what we do is an expected credit loss model, where you incorporate forward-looking information, and generally, the expected credit loss will result in you recording a losses before this actually incurred. So there's an earlier recognition of losses, and this change in the standard came in 15 years or 20 years earlier, after basically the Lehman Brothers scandal, etc., where they did not record the loss because losses were not incurred. That's why we moved from the incurred loss model to the expected credit loss model, where you factor forward-looking information to record losses earlier than where the loss has actually been incurred. So it's applicable, as I said, for all instruments measured at amortized cost. It is applicable for debt instruments which are measured at FVOCI. It is also applicable to any financial guarantees that I have given. A bank may give guarantees, on behalf of the customer. So financial guarantees on behalf of a customer. So you need to record ECL for that. Loan commitment, the bank may give a loan of 500 rupees, of which only 200 is drawn. 300 is still committed, but the borrower has not drawn that. ECL on that also needs to be recorded as per the prescribed methodology, or as per the prescribed guidance, not methodology, prescribed guidance given in Ind AS 109. So it is all encompassing. It doesn't only restrict itself to what is recorded in the balance sheet. What is not recorded in the balance sheet as well, you need to record an ECL, expected credit loss, using an appropriate methodology. So you look, as I said, it incorporates forward-looking information. You need to evaluate the credit risk of companies, etc. And a lot of judgment. The standard does not prescribe how to calculate expected credit loss. It just, broad guidelines. It prescribes, of what all factors you need to consider when you consider ECL, but any particular methodology, any particular percentages, etc., are not given. It is left to the company to find out, what is the level of losses that needs to be recorded, which will best reflect, the losses that they're likely to incur or likely expected to incur in the future. So a lot of judgment will be involved, a lot of statistical techniques needs to be considered. You also need to consider forward-looking information, how employment rates will move, how the GDP will move, how a particular industry, if you're exposed to, say, airline industry, most of your customers are, airline companies, then, how the airline companies will fare in the near future. If they're not going to be doing well, then possibly, there's a potential of expected credit loss. So a lot of information, historic as well as current, as well as forward-looking information, needs to be considered while computing the ECL. So basically, there is two approaches, I would say, three if you did POCI. One is the general approach, which is applicable to loans and securities, where you basically, classify the financial asset into three: stage one, stage two, stage three. And I'll briefly talk about that in some time. Then there is a simplified approach. This is majorly applicable to corporates for trade receivables, where you use a provision matrix to record. You see how your debtors aging has moved from one bucket to the other over a period of 3 years or 5 years. Say at the end of year one, it would be within the 0 to 1 year bucket. The end of year two, it would be in 1 to 2 year bucket. So how that particular debtor has moved between various buckets over a particular period. You can do it quarterly. Generally, it's done quarterly. So the first quarter, it would have been in the 0 to 90-day bucket. Then next quarter, it would have been in the 90 to 120-day bucket. So how those particular data have moved within the buckets over a historic period. And finally, it goes to the last, say about 1 year or about 2 years, where it will be considered that no money will be received. So how it has moved, and then you compute your ECL. There is basically provision matrix. A lot of models, Excel models available to compute the simplified approach. So you use that to compute, and is generally used for trade receivables or contract assets. General approach is generally used for long-term loans, which is given, mainly by banking sectors, NBFCs, etc., banks. And then again, purchase or original credit impaired approach, again relevant mainly for financial services sector, where they purchased distressed loan, either from banks or from the market, etc. And how do you compute the ECL with respect to those type of assets? So as I said, impairment of financial assets, basically The general approach requires you to categorize the assets into three loans into three categories. Stage one, where you record 12 months expected credit loss. Stage two, where you record lifetime expected credit loss, and stage three, where you record lifetime expected credit loss. So what do you mean by 12 months expected credit loss? Is basically, a loan tenure will generally be, 3 years, 5 years, 8 years. Home loans can be 10 years, 15 years as well. So when you mean expected credit loss, 12 months expected credit loss means that any defaults which are likely to occur within 12 months, say, of the reporting date. So if there's a 10% probability that losses will occur within 12 months of the reporting date, then your probability of default is at 10%. And then assuming that the default occurs, what will be your losses in that loss given default, which will be your lifetime losses with respect to the defaults that are going to occur within 12 months from the reporting date. So that is called as 12 months expected credit loss. Lifetime expected credit losses, default may not occur within the next 12 months. It can occur, from 12 to 24 months, 24 to 26 months, etc. So you determine the probability. It could be, say, 10% within the 0 to 12 months. It could be 8% within, 12 to 24 months. So when you do basically stage one, you only consider, say, 10%, which was what is going to occur within the 12 months. And 12 to 24, 8%, you don't consider if the assets are in stage one. But if the assets are in stage two or stage three, you determine the probability of the default occurring through the life of the loan. And then you determine the loss. So stage one, you'll record lesser losses because you only assume defaults in the next 12 months. While in stage two and stage three, you'll record more losses because you're assuming defaults can occur after 12 months through the life of the entire instrument. And then, of course, you accordingly calculate the loss that is likely to how much money you're going to recover and calculate the loss that you're going to incur, assuming what is the default that is going to happen. The difference between stage two and stage three both require, lifetime expected credit loss to be recorded. The only difference between the two is, you basically in stage two, you continue to recognize interest income on a gross basis. If 100 is a loan, I continue to record interest on 100 rupees. While on stage three, I record interest on a net basis. 100 is a loan. I have recorded a loss of ECL loss of provision of, say, 60 rupees. So I record interest income on 40 rupees. While on stage two instrument, I will record interest income on 100 rupees. So that's the only difference between stage two and stage three with respect to the interest income. Otherwise, computation, more or less, you do lifetime expected credit loss. Of course, the probability of default, etc., can change in stage two and stage three. Stage three, the probability of default is already defaulted, right? So it will be 100%, while stage two may not necessarily be 100% probability of default. So this is how you stage your assets. So stage one is, assets which are not defaulted. And basically, generally, this is a broad criteria. There can be additional qualitative factors also which we need to evaluate. But generally, assets which are not defaulted or which are past due less than 30 days. That is stage one assets. Assets which are not defaulted, loans which are not defaulted, and which is past due less than 30 days. Stage two is, assets which are defaulted between 30 to 90 days. And stage three is assets which are actually defaulted. That means so the probability of default is 100% out here. So that is anything above 90 days is considered to be stage three. So this is how you do the staging, and you basically record your ECL loss, ECL provisioning. So basically, stage two is also called as a significant interest increase in credit risk. Basically, when they are due between 30 to 90 days. While, as I said, 30 to 90 days are broad parameters, you can also use qualitative factors where any assets which are, less than 30 days overdue can also be brought to stage two, etc. So it's not that you need to only follow the 30 to 90 or above 90 day. Qualitative factors also can be considered to determine the staging. So this is with respect to the impairment of financial assets. Next, we will quickly talk about derecognition of financial assets and then derecognition of financial liabilities. So what do you mean by derecognition of financial assets? When do you remove the financial assets from your books? Trade receivables. When do you remove your trade receivables from your books? Uh, this is probably one of the most complex. Wherever the transaction is very complex, the uh, answer when you enter into factoring arrangement or securitization arrangement, etc. This flow chart is generally applicable, but where applicable, it can get to very, very complex scenarios for money recognition of financial assets. So when you generally derecognize an asset, when you receive the money, right, the contractual cash flow is received, the contract expires. So in that case, basically you derecognize the asset. But in certain cases, you may sell the asset forward to somebody else. So can you derecognize the asset or not? So Ind AS 109 has very, very detailed guidance with respect to basically when you derecognize the asset. Which is a 9-step flow chart which you need to follow. You need to determine at what level you need to aggregate the loans. Whether you do it at individual loan level or at a total loan, whether you do standalone financial statements or loans, or you take standalone, and because sometimes you may sell the loans to subsidiaries, or you consolidate all the loans to do the analysis. Then is the rights to the basically contractual cash flows expired? When will the contractual rights to the contractual cash flow expire? Basically, when you receive the money, right? Then the next step is the most important, is the risk and reward. Have you substantially transferred the risk and reward with respect to the contractual cash flows? So if the entity which is holding the debtors has substantially transferred the risk and rewards with respect to the contractual cash flow, then they derecognize. If they have retained the risk and rewards with respect to the contractual cash flow, then they will not derecognize, and any money received is considered as a borrowing. It's just that you continue to be exposed to the credit loss. You're just taken a borrowing against the debtors. So you don't derecognize the assets, you will basically recognize the money received as a borrowing. This is when a significant risk and rewards have not been transferred. There could be scenarios where you are neither transferred nor retained significant risk and rewards. So then you do what is a control test. Do you have control over these loans? If you have control over the loans, you continue to record the asset to the extent of your continuing involvement. So these are the various steps that needs to be followed. Basically, the risk and reward and the control test to determine whether to recognize the financial asset or not. So very complex. Briefly try to talk about this in this flow chart. But in most scenarios, as I said, it should be simple. Step 3 basically has a contractual right to receive the cash flows expired. That means, have you received cash? If yes, then you directly derecognize the asset. So most cases you may not need to go beyond step 3, but in case you need to go beyond step 3, that's when basically the complexities arise. The risk and reward test and the control test. Derecognition of financial liabilities. When do you derecognize a financial liability? Basically, when it is liability is discharged or extinguished, or there's a substantial modification. So when is a liability discharged? When there's a legal release, you are borrowing, you repay, you're legally released from it because you repaid the borrowing. So we discharge the liability by paying the creditor. Or sometimes the legal release can also happen through a court scheme. So the court may tell you don't need to pay, etc. So in that case, when there's a legal release, then you can derecognize. Sometimes you may need to derecognize if the terms of the instrument have been substantially modified. A plain vanilla borrowing, non-convertible debenture gets converted into equity shares or a convertible debentures. Then the terms of the borrowing is completely different. Earlier borrowing is completely different from the new borrowing. There's a substantial modification to the existing instrument. So in that case, what you do is you derecognize the old asset, old liability, recognize the new liability, and the difference between the two is taken to P&L. So these are the scenarios when you will basically derecognize the financial liability. So basically, we have covered aspects around what is a financial asset, what is a financial liability, how do you define what is a financial liability, what is an equity, a compound instrument, classification of financial instruments, both assets and liabilities, impairment of financial assets, and also we talked about basically derecognition of financial assets and liabilities. You would have seen that a lot of financial assets and liabilities needs to be measured at fair value. Initially, I said that Ind AS 113 talks about fair valuation of financial instruments. So how do you determine wherever fair value is required? How do you determine the fair value? That is governed by this standard, basically Ind AS 113. So what Ind AS 113 says is that fair value from an asset perspective should be the exit price, basically the price that I would receive from selling the asset. In an orderly transaction, we have to look at it from a market participant's perspective, not from an entity's perspective, but from a market participant perspective. So how much I'll receive to sell the asset, that's an exit price in an orderly transaction between market participants at a measurement date. That is how I will measure a asset. Liability is price that would be paid to transfer the liability, again in an orderly transaction between market transactions and at a measurement date. So it has to be an orderly transaction. It can't be something under duress. So that's why you're saying you look at it from market participant's perspective and not from an entity's perspective. So you determine fair value basis the exit price, basis these three parameters. Again, from a liability, it doesn't mean that you need to repay the liability. The liability continues to remain. Only thing is how much you need to pay to transfer the liability to another person. Certain things that you need to look at, when you're measuring and determining the fair value. One is, what's the unit of account? Are you measuring an individual share? Like, you have investment in equity shares of a subsidiary. What is the unit of account here? Is it the individual shares or the entire investment 60%? If you have your investment is say 60% in those subsidiary. So unit of account, is it the entire 60% shares or it is individual share? Because when you take the unit of account of 60%, there's something called as a control premium. That can impact the fair value. While for one share, control premium is not really relevant. So you need to determine, what is the unit of account. Ind AS 113 does not provide you what the unit of account is, but you need to look at the relevant standard which could provide guidance with respect to what the unit of account is. Then you need to look at what is the market. That the sale has to take place in the principal market or the most advantageous market. What are the markets that if I have an asset, the investor has access to. Understanding the market and determining what is the principal market, and in the absence of a principal market, what is the most advantageous market. Then you need to look at the assumptions. What are the assumptions that market participants would consider while taking into consideration the valuation of the asset or the liability. That those are something which need to consider. The credit risk of the person in case of determining the debentures, the performance if you're doing valuing equity shares, the growth potential of the company, what are those assumptions, etc., that will be used. Then what are the characteristics of the assets or the liabilities? If you're valuing agricultural produce, basically, and you need to move it from location 1 to location 2, then whether to incur transaction costs or to move the goods from location 1 to transportation cost to move the agricultural good from location 1 to location 2. Sometimes you may have equity shares where there could be a lock-in period. Whether the lock-in period is this is contract between two parties or it is inherent in the articles of association of the company. Those are the factors. If it is inherent in the articles, then it's a characteristics of the instrument. But if it is between a contract, then it's not a characteristic of instrument. But what you're measuring here is the instrument, and therefore you only need to consider factors which are there between the instrument and not basically the contractual arrangement between two parties. So those are the assumptions which needs to be considered. Inputs and valuation techniques also would need to be considered, basically in determining basically what should be the if you are valuing equity shares, what should be the appropriate valuation technique? Should it be Black-Scholes? Should it be binomial model? What should be the growth rate that is used? What should be terminal growth rate that is used? So all these things should be considered when you're determining the fair value of either a financial asset or a liability. The standard does not basically prescribe any valuation technique. Basically what it says is, use that technique which maximizes the use of observable inputs and use minimal unobservable inputs, and consider the characteristics of the asset or the liability from a market participant perspective. The location of the, if you have fixed assets you're using, this is the revaluation model. Your plant and machinery, the condition of the plant and machinery. Then if you have, a property, the location of the property, if it is in the heart of the city, the price is likely to be more. If it is, in the suburbs, the price is likely to be less. Restrictions, whether the restrictions on the sale or the instrument, whether it is, the restrictions are on account of a contract between two parties or inherent in the instrument itself, like in the articles, etc. Those will also impact your fair valuation. So these are the factors that needs to be considered basically when you are determining the fair value of an instrument. So basically, there are three approaches which is generally used: a market approach, a cost approach, and an income approach. Market approach is an approach, where that instrument is basically traded in the market, or a similar instrument is traded, similar and identical instrument is traded in the market. So you basically determine the value of that basically basis the instrument which is actually traded or a similar instrument which is traded. That is generally called as a market approach. Cost approach is a replacement cost. So this is generally used, when you are determining the fair value of, property, plant, and equipment, or your intangible assets, etc. Intangibles, of course, there could be other approaches as well, but property, plant, and equipment, is generally valued using the replacement cost. If I have to set up the machinery again, what would be the cost that I would incur, etc. today. So that is the methodology that is used. Income approach, when you have invested in unlisted equity shares and there are no comparable shares in the market, listed market, then you use the income approach. You use basically a discounted cash flow method to determine, what is the cash inflows I'm going to receive over the life of the instrument, and then discount it to a single amount, and that becomes the fair value of the instrument. These are the three valuation techniques that is used. Then again, once you do the valuation, as I said, there are significant disclosures that you need to give. You need to basically, for instruments which are measured at fair value and for instruments which are measured at amortized cost, you need to disclose the fair value as well. Okay, so you need to categorize them into three: level 1, level 2, and level 3. Level 1 is, where the quoted prices is available in the active market. Basically, so, say Infosys, shares of Infosys, you invested, the price is available. So that generally goes basically in level 1. Level 2, observable inputs other than quoted prices are directly or indirectly available. Forward contracts, basically forward contract for foreign exchange contracts, with maturity of 1 year or 6 months, etc., where the inputs, the interest rate curves are observable inputs which you can get from the market. What is the interest rate curve between the two countries? So those are basically observable inputs. So those are generally level 2. And level 3 is, where you do the valuation basis your equity shares, which are not listed. So there you use more of unobservable inputs. So you need to categorize all your instruments into level 1, level 2, and level 3. And, more disclosures are required to be given for level 3 instrument. What are the inputs that you use, sensitivity analysis with respect to if you change the assumptions with respect to some of the key inputs, how much the fair value would increase or decrease. So those type of disclosures are required for level 3, while for level 1 and level 2, minimal disclosures are required. Level 1, I don't think you need to give much. Level 2, some key disclosures may be required. So when you are done with the measurement, when you come to disclosures, you need to categorize all the instruments, whether measured at fair value or not, into level 1, level 2, and level 3. So this is it with respect to a very brief snapshot. I know I was quite quick. I had a lot to cover within a very short span of time. So this is more a bird's eye view. Hope you were able to get a basic understanding of financial instruments, and it's piqued your interest to learn more. And you can, of course, basically go through the accounting standard, and there are a lot of other training materials also available. And please feel free to reach out to me in case you have any questions. Yeah.
Thank you, Siddharth,
Yeah.
for the insightful session. So there are some questions which have come
Yeah.
from the live audience. So the first one is that should an advance received from a customer be classified as a financial liability?
So advance receipt from a customer, see, it's a good question. Generally, it will not be a financial liability because there's no contractual obligation to pay cash, but you need to look at the terms very minutely to see whether there's a direct or an indirect obligation to pay cash. So in case there's no contractual obligation to pay cash, it would generally be considered to be a non-financial liability.
Right. And then there is a further follow-up that what will be the case where even there is a lock-in period of the mutual fund, still the fair value should be considered or at cost?
So first, when you determine whether the instrument, you need to determine a classification of the instrument, whether it meets the SPPI test or not. And generally, in 9 out of 10 or 99% of the cases, the SPPI test with respect to mutual funds, very, very, very rare cases will then SPPI test be met for mutual funds. I have not seen practically the SPPI test being met. So in that case, since the SPPI test is not met, you'll not really measure it amortized cost. It will generally go as a FATPL instrument with respect to mutual funds.
Right. Thank you for that. So the next question is that under Ind AS 109, if an entity initially measures a financial asset at fair value and later decides to hold it for a long-term purposes, how does the measurement basis change and is it allowed to switch between the categories?
So see, initial assessment of whether the instrument should be at amortized cost or debt FVOCI or FVTPL or equity FVOCI will need to be done. You need to do the business model assessment at inception. I'm assuming that this is a debt FVOCI, a debt instrument, not an equity instrument out here. So you do the initial assessment on day one, and if your basically business model at that point in time is to hold it till maturity, then you will measure it at amortized costs. Subsequently, the standard permits you to change the business model, when there are certain circumstances, and it has to be evidenced, at a very, very high level, board of directors and, evidence that your business model has actually changed. And in case your business model change, you can move from debt FVOCI to amortized cost to debt FVOCI, but that is expected on a very rare circumstances. Generally, the business model I would expect to remain the same unless, businesses really change. One would be, say I'm into a retail business. I'm a loan and I work with retail as well as wholesale, and I want to exit the wholesale business. And therefore, I'll start selling my loans. I will not hold it till maturity. As and when I get the opportunity, I'll start selling the loans. And in certain senses, I'll hold it to maturity also. So then in that case, there is a business reason for me to change the business model because I'm actually exiting the business. So those are the circumstances where, you could change the classification with respect to debt instruments. As I said, equity FVOCI, the business, once you designate at day one, though that cannot be changed. That is an irrevocable designation.
Then the next question is on how is the concept of the highest and best use applied when measuring the fair value of non-financial assets?
See, it really depends upon, what you're valuing. It's a very good question, but I will need to understand what you're valuing to be able to tell you what the highest and the best use is. But a typical example where I could tell you highest and best use may not necessarily be the use that you are doing. You may have basically invested in a parcel of land and developed a factory. Okay. For your manufacturing purposes, and you may have done that over 4 years or 5 years back. And subsequently, basically, 5 years or 8 years after that, the landscape of that location has changed. A lot of residential complexes have come in, and developers are building the building, etc. So while your own use is to continue to use it for manufacturing purposes, the highest and best use in this particular scenario would basically be with respect to building the residential premises, and you determine the impairment testing basis that. Again, it's very subjective. It will not happen in most scenarios like this. But yeah, there can be scenarios when the highest and best use will not be the own use that you're doing. Most scenarios, 9 out of 10 times, the way you're currently using will be the highest and the best use. But in certain circumstances, it could change.
Right. Thank you for that. Then what inputs are considered in determining the fair value under level 1, level 2, and level 3 of the fair value hierarchy?
So level 1 is, if your shares are quoted in an active market, say recognized stock exchange, BSE, NSE, that is level 1. So you don't do any adjustment to level 1 prices. It's just the quantity into the price. And it has to be quoted in active market, and trading should be, it should not be minimal trading. It should be actively traded. That instrument should be actively traded in an active market. That is level 1. Level 2 is, the same instrument, is not traded, but a similar instrument, very similar to yours, is either traded or, inputs are observable in a market. So typically, derivative instruments, like interest rate swaps, cross currency swaps, forward contracts, etc. You don't have listed prices of that. How do you determine the fair value? You use the interest rate differential, right, between the two countries. If you have a forward contract in USD, you use the interest rate differential between the two countries to determine the fair value. So those are observable. You know what your interest rate are likely is to be in a 1 year, 2 years. Long dated, of course, may go to level 3, but generally, between 1 to 2 years, the inputs are observable. So those go to level 2, and level 3 is unobservable inputs, generally unlisted shares.
Correct. So I think just follow up on level 3. Walk us through a scenario where a company might need to adjust the fair value of a level 3, and what will be the key considerations in that?
So assume, that you have invested in shares of a company, which basically is in real estate sector and in a particular region, and the real estate values in that particular region are going down. So in that case, because observable prices are not available. I'm assuming observable prices are not available, or there's not too much of sale in the near future. We need to make some adjustments to the inputs to basically something called an overlay. We generally use a management overlay for ECL, but something similar to that, we may need to use some level of adjustments to reflect, what is your expectation of the money to be received. Again, this has to be scientific. It cannot be completely management driven. There has to be a basis of those adjustments. But again, those depends upon facts and circumstances of each case, and can't really provide one answer to any all scenarios applies to all scenarios.
Right. And then again, relating to level 3, for a level 3 asset like a PE investment or a complex derivative, what are the best practices for validating the unobservable inputs and assumptions used in the DCF model? And how can an auditor gain sufficient, assurance?
So I think what I would do first as an auditor is I would do look back testing, right? So basically level 3, you would generally use a discounted cash flow technique, right? So I would do the look back testing. They would have used some assumptions in the previous year. How strong is the budgeting process? How accurate is the budgeting process in the previous years? So if they have budgeted 100 in the previous year and they only achieved 20, that means, that there is some issue with the budgeting process, and, we need to challenge the inputs that are used. So that is day one. And I think that at least, if you have already done few such valuations, you would be able to do that. That would be the best test to determine. Second is, believe which industry you are in. So, if you have, say, invested in health tech sector, what is the industry growth rate of the health tech sector? So is the assumptions consistent with the industry growth rate? And typically, I've seen companies, will lose very lower growth rate in the initial 3 years, 4 years. And in the fifth year, the growth rate, just when you calculate the terminal value, you will basically have a 30% or a 40% growth rate. And then you calculate the terminal value basis the fifth year's projections. So, those type of projections where suddenly in the fifth year it spikes is also something which I would, look at with caution. And yeah, apply judgment, and discuss with the management, understand the basis, and understand the discount rates that have been used, ensure that they are appropriate, and also ensure that proper disclosures are given with respect to the sensitivity analysis and other disclosures, the inputs that are used, etc. So those are relevant. Again, can't give a answer which will fit all scenarios, but yes, be skeptical when you're doing this work.
Yeah, thank you so much. Then further, does investment in mutual funds needs to be restated at fair value at every quarter or yearly is enough?
It depends upon what your reporting period is. So if you're reporting on a monthly or a quarterly basis, you would need to, and again, materiality is also something which you need to look at. But yes, from a reporting perspective, leaving aside materiality, if you're reporting on a quarterly basis, then you need to do it quarterly, including, when you're management reporting also, right? So I would believe it will really depend upon the reporting period of the entity. You need to do it whenever you need to report as per Ind AS.
So one of the last questions is, in cases where employee benefits like bonus or incentives are variable or conditional, how should they be classified as financial liabilities or provisions?
That is a very good question, whether it is a provision or a financial liability. There is, I believe, an EAC opinion on that. So you may want to look at that EAC opinion to determine, factors are given, whether it's a contractual liability or whether it is coming from it's a provision, etc. So you may want to evaluate that EAC opinion to determine whether it's financial liability or provision.
Great. Thank you so much. So I think these are all the questions that we had from the audience. So thank you so much, Mr. Siddharth Iyer, for all your insightful points that you mentioned in the session. I think all your practical experience over the last 20 years, which you shared with us in terms of the real cases as well as the practical examples, has been really insightful, I'm sure, for all the attendees. So really thankful for sharing such cases with us. And apart from that, I would just like to thank the Accounting Standards Board with the this Brain Gain series, which is being carried forward, and with all the such interesting sessions which are there for enhancing the knowledge of all our stakeholders, including members and CFOs. And of course, for the audience for an engaging session and for posting interesting questions at the end of the session to help us navigate all the practical aspects which are there. Thank you everyone for the session.
Thank you. Thank you. It was a pleasure speaking on this. Look forward to many more such sessions.
Thank you everyone. Have a great day. Bye.
Thank you.